Hello and welcome to the January 20th, 2023 edition of Watching the Tape. So Bed Bath & Beyond is teetering on the verge of bankruptcy. And I got to think that nearly everyone, if not everyone, has been to a Bed Bath & Beyond. This is where you go when you're moving from apartment to apartment or finally into your first house, or maybe you've been there to buy some home furnishings for your children who are moving away to school or into their first apartment. They're everywhere. There's close to 1,000 of them. I got to think that everyone is familiar with Bed Bath & Beyond. All right. So let's start by looking at a stock price for Bed Bath & Beyond over the last 10 years. And we can see that the stock price is down 95% from its peak in, looks like the beginning of 2014. Let's look at the bond price. Let's not forget bonds. So this is actually just a one-year look back. And with bonds, they're issued at what's called par, or 100 cents on the dollar. And then they are redeemed at par, or 100 cents on the dollar. So the price there on the right side is 100. That's where they should trade, roughly where they should trade if there are no concerns about the creditworthiness or being paid back. And so as recently as March of last year, so less than 12 months ago, this thing was trading at par. So that's an indication that credit investors, bondholders, not too concerned about the creditworthiness of Bed Bath & Beyond. So how does a company that is it's an American staple of retailing, how does this fall into the bankruptcy abyss? And there's a great quote that you've probably heard. It tends to get overused. It's from Ernest Hemingway, or it's from an Ernest Hemingway novel, in which one character asks the other, how did you go bankrupt? And the response is gradually and then suddenly. And I think that applies here as we'll see. So in a previous life as a junk bond analyst, I used to study companies like Bed Bath & Beyond in order to help me avoid investing in the next company that might suffer a similar fate. So what were some of the warning signals here that could have foretold that a day of reckoning was coming for Bed Bath & Beyond? So for this video, we're going to turn back the clock 10 years and sort of look at the credit ratio, or excuse me, the credit ratings and the financials, just to kind of see what we can learn looking back in time. All right, so first, let's do a recap of how the credit ratings work. And so Standard & Poor's, S&P, is a credit ratings agency. And what it does is it assigns credit ratings to companies based upon their credit worthiness. So AAA is the best, and then it goes down from there, down through junk bonds, down to the bottom there, which is single C, which is basically on the doorstep of bankruptcy. All right, Bed Bath & Beyond was an investment grade company in 2013 at BBB+. And in fact, it was upgraded in 2014 to single A-, so strong investment grade rated company. Then in 2016, it was downgraded to BBB+, followed by another downgrade to BBB in 2017. In 2018, it was downgraded to BBB-, which is just on the edge there, just on the precipice of going from investment grade down to what's called junk or high yield. And that happened also in 2018 when it was downgraded to BB+. And then in 2019, one notch downgrade to BB. In 2020, two notch downgrade to B+. And another two notch downgrade in 2022 to B-. Another two notch downgrade in 2022, also in 2022, to CCC. And then again in 2022 to CC. And that's where it stands now. So it's interesting to look at the credit ratings, kind of the migration of credit ratings. But the knock on credit rating agencies is that they are backward looking. So they tell you something is bad long after everyone else knows that it's bad. So we're going to take a firsthand look at the financials over the last 10 years to see what we can glean from the kind of the progression of financials over that period. All right. So we've got 2013 all the way to LTM, which is the last 12 months. And this 2022 column, I should point out that it's a bit stale. It's a fiscal year, and this fiscal year 2022 ended in I think February of 2022. So that just know these numbers are a little stale there. The LTM is the most recent column. All right, let's take a look at the top line. So revenues in 2013, kind of bumping up against 11 billion, growing steadily to over 12 billion by 2018, and then started to see some decline in the revenues there, and really saw some decline in the last couple periods there. So how much of that could be explained by store count? So let's look at the store count. And we can see in 2020 that there were 1,500 stores, and then in 2021 there were about 1,000 stores. So a major decline. They sold some businesses, and with that, some stores to go along with it. So that can explain some of the decline in revenue. All right. Let's look at margins, so profitability. And margins, gross margin was 40% in 2013, kind of bouncing along there in the high 30s before seeing some real margin erosion in recent times, and then down to a gross margin of 26%. So severe margin compression just recently. Let's look at the balance sheet. So you've got cash and debt. And if we look at debt, for example, no debt in 2013 and 2014. So that would explain the high credit rating of single A minus. Then they issued about 1.5 billion of debt and stayed there for several years before getting to 2021, when there was actually a pay down in debt, and that's probably related to the sale of some business lines. Use some of the proceeds there to pay down debt potentially. So if we get to just the most recent period there, it's at 1.7 billion. So I'm not seeing anything terribly disconcerting on the debt front. However, if I look at it in connection with cash and look at what I call, or what's called, a net debt position, so it's debt minus cash, then you start to see that there is some financial, not distress necessarily, but you're seeing more debt on that balance sheet in the most recent period, significantly, right? You're going from, in 2021, a negative net debt position, meaning there was more cash than debt, to a couple years later, you've got 1.6 billion of net debt and a small cash balance there relative to what it's been historically. All right. Let's look at free cash flow. And free cash flow is just cash flow from operations minus capital expenditures. Should be positive for a healthy business. And it had been until you saw in 2021 some signs there that things weren't going so well on the free cash flow front. And then the most recent period there of over $1 billion in what's called cash burn. This is no bueno. This is very bad, and starting to explain why we're seeing the pricing in the stocks and the bonds where they are today. Share buybacks. So I include share buybacks here because Bed Bath & Beyond has been what I would call fairly aggressive and fairly irresponsible on the share buyback front. So think of share buybacks as using debt to buy back shares. This is effectively what it is. So instead of using cash to pay down debt or to invest in the business. It's just going out the door to shareholders at a time. If you look at in 2022 and in the last 12 months, it's pretty shocking that share buybacks were still occurring when management was seeing some pretty major warning signs on the operations front. And leverage ratio is the last one here. This is a popular metric among credit analysts, and it is debt relative to earnings. So if debt is $1 billion and earnings are $1 billion, then your leverage ratio would be 1. And that would be a healthy leverage ratio. So as we look there, very healthy, below 1 until 2019, and then it came back down in 2020 to below 1, and in fact was negative in 2021. And then the March, it seems, started higher. In 2022, leverage was at 2.5 times, which is not unsustainable. Now, remember, those are stale numbers. And in the LTM period, it's not meaningful. NM, not meaningful because earnings are negative. So you got lots of debt and negative earnings. This is a bad situation. Okay. When I started this exercise, I was really hoping that some major flags would be revealed going back 2-3 years, but it really wasn't the case. It's really only in the most recent period that things look super dicey. Now, if we go back to the bond price, let's revisit that, because the bond price reflects credit investors' expectations for a company. And if you're paying 100 cents on the dollar for a bond, as recently as last March, really aren't any concerns about the creditworthiness of this company. So it's amazing how fast it has fallen and in kind of the subsequent period there. So what's the lesson from all this? And this isn't going to be a surprise for the regular viewers of this series, but diversification is important. It's worth repeating. Bed Bath & Beyond was a very highly rated large cap company with strong market share just a short while ago. So who could have foreseen the financial distress that is plaguing the company right now? And it actually didn't look too bad until, frankly, it's too late to get out of the investment. So I think it's misguided sometimes when I hear investors just say, well, they'll get out of the investment when the storm clouds start to form on the horizon, because by then it's just too late. So that is it. Thanks for watching. We'll see you in 2 weeks.